Dear friends, thank you for supporting this channel on Patreon to join our growing family of donors, now 59 patrons strong. And remember, once we reach 100 active patrons, we will start sending out a 1-ounce U.S. Silver Eagle, autographed by your host, Dunnigan Kaiser, to one active supporter each and every month. Thanks for taking a minute to pitch in by going to patreon.com/reluctantpreppers and pledging your support today. Thanks very much!
Hey Reluctant Preppers, this is showing you just how easy it is to purchase silver without paying any premium over spot price. You just go to sdbullion.com/rp, scroll down and enter the special code to get silver without any premium, and they'll mail it to your mailbox, discreetly packaged. Inside you'll find a beautiful 10-ounce bar of fine silver, and you are able to purchase that and have it and add it to your stack and your collection without paying any premium, and you're supporting Reluctant Preppers along the way. Thanks.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We're privileged to have this returning guest. Wayne Jett is the author of The Fruits of Graft. He has a more than 3 decades legal career up to and including the U.S. Supreme Court. He's been on our channel talking about how a collusion of banks and government caused the Great Depression of the 1930s in the United States and globally. He's back to talk with us about how more recent financial collapses have been orchestrated and lead us up to the current day and what we're facing next. Wayne, thank you for joining us again here on Reluctant Preppers.
Thanks for asking me, Dunnigan. I'm delighted to be back with you.
You took us through a very shocking and eye-opening expose the last time we talked about the roles of presidents of the United States, owners of major banks with international ties that were not American and not of our government, and how they colluded to hoodwink and extort and damage the American people, and specifically the middle class, trying to drive us to back into the era of serfdom, really, when you have a very small overlord class and the rest of us being basically wage slaves serving them. And it's gotten an overwhelmingly positive response from our viewers, and they're saying, please bring Wayne back on. We want to hear more of this story, because we left the story off shortly after the Great Depression. And in your book, The Fruits of Graft, you talk about how it was not just that one huge multi-decade depression that was orchestrated by this collusion and this cabal, but other major collapses since. And I wonder if you could give us at least a brief thumbnail sketch of some of the next, like around the year Y2K and the great dotcom bubble and collapse. Was that also just a natural market exuberance that just came to what happens to markets when they get ahead of themselves, or was there more to it than that? Because a lot of people were severely damaged financially in that event, and there's a saying that if your 401k is starting to look like a 101k, that's what happened the year after the dot-com bubble collapse. So welcome again, and if you could talk to us about that next collapse and bring us on forward toward the present day.
Well, if I could just give a brief little run-up to that tech crash to make the point that you've already made, that this is the Depression was a major event in a running series of things throughout the entire century. And as you find out in Chapter 17 of my book, late in the book, there was a plan in place from 1901 in writing. And just let me run through a ticker tape, kind of ticking off the various other events before the Great Depression and after. World War I, that was very much a ruling elite operation, including people from the United States, very importantly in it. The so-called Spanish flu of 1918 killed more Americans than all of our wars put together, including the Civil War. And they were all young usually strong men, young people, and there's the bloom of their health. Then we go to we can jump to the crash. You find out also in chapter 17 of my book that there was a place around the world. A man was being interrogated under penalty of death by Stalin, by his NKVD, and he described the crash of 1929 as a more significant revolutionary event than the Bolshevik invasion of October 1917. A more important revolutionary event in what he called the real revolution than the Bolshevik invasion of Russia and turning it into the communist dictatorship that it was for 70 years. Then we go to the Great Crash. We could spend some time on World War II, if certainly another event of the same nature. Let's jump to 1971. A very important event took place on August 15th of that year. President Nixon was in office. He had a meeting at Camp David, and a weekend meeting with his senior financial staff. And late Sunday afternoon, he made an announcement that there would be a new cost of living council and there would be a wage price freeze. The announced battle against inflation, fighting inflation, whip inflation now, and so forth. What was also done that same day, which was the real news that was in effect covered by the so-called battle against inflation, is that they closed the gold window even for European central banks. No more gold goes out for exchange of dollars. So it was completely cutting the dollar away from gold. And of course, the price of gold went from $35 an ounce, which it had been under the Bretton Woods Accords from 1944. It went from $35 an ounce. Within 18 months, it was about 4 times that, and it went on up from there. We could jump on then quickly to 1980. 1979, October, was when Paul Volcker was made chairman of the Federal Reserve. And of course, later on, he would be given the credit of breaking the back of inflation. Well, I would like to give him a lot of credit, and I will do so for causing the inflation, much of it in the first place. He was a major player, Paul Volcker was. He was Undersecretary of Treasury at that August 15th, 1971 meeting when they went off the gold standard. And of course, we were selling gold at $35 an ounce to those foreign banks, to the international banks, I should say. And they knew what was coming. The insiders of the Fed, they knew as well as I'm sitting here. And they were buying all the gold they could, and we were running out of gold and so forth. And so that's supposedly why we closed the gold window to save the rest of our reserves. But Paul Volcker then became chairman of the Federal Reserve in October 1979. And the first thing he did is announce that we were going to go off the approach of regulating interest rates or regulating the money supply by controlling the overnight funds rate, which is what is supposedly still being done now, if you could call that managing the money supply at all, the way it's done now. Back in those days, supposedly they were using Milton Friedman's formula for how to do this. They were going to his approach of money quantities to make sure that inflation could be kept in hand. Let the market determine the interest rates, and we'll just watch those interest rates and then determine how much money we ought to put in into the economy. Well, what he did most definitely when he first got in, October 1979 was just before the 1980 presidential election for President Carter's run for re-election. And of course, Volcker was charged with getting him reelected. Well, his approach to doing that was to put, I don't know how much, but he put a lot of money into the money supply. And lo and behold, people had been upset and concerned about the rising price of gold and therefore indicating inflation down the line. And it was $225 an ounce and so forth. Well, Volcker added enough money into the money supply that not only did interest rates go up, but the gold price went from the 225 area or thereabouts it got to a high in the summer of 1980. That's only less than 9 months later, $892 an ounce. I mean, just a tremendous climb, almost straight up if you look at the graphs plotting the gold price. And it's funny these days, Paul Volcker gets all the credit for breaking inflation's back and none of the credit for causing it in the first place. And I might mention, in case you didn't know, Paul Volcker wasn't just a public servant and a so-called economist. He was a man from Chase, Manhattan. In other words, he was a Rockefeller man. He had been with Chase Manhattan before he became undersecretary, which he was. That was undersecretary for policy and therefore in charge of monetary policy. But he was from Chase Manhattan then, and he went back to Chase Manhattan before he became Fed chairman. So that's who we were talking about in the tall man that was regarded as so responsible in governing inflation. Well, that was such a catastrophic rise. Not only was there the sharp rise in interest rate in the gold price, interest rates went to double digit. We're talking about on commercial loans, bank loans, even treasuries and government securities were obviously sky high. If that sort of thing happened today, it would certainly bankrupt the government overnight. There's no way to pay that in that circumstance. Well, so even practically before the election, Volcker reversed field and started sucking money out of the economy. And in that circumstance, the price of gold started falling sharply. And with it, the economy with the very high interest rates was on its back, and he was sucking money out of the economy to make it even worse. And so we had that kind of I could go into more detail of what actually caused him to stop sucking it out if you want me to, but otherwise I'll just go ahead and say that, well, he brought the price back down to gold. I will mention one thing about it because I think it's very instructive that I believe it was 1982, St. Patrick's Day, that my former colleague and mentor in some respects in regard to economics, Jude Winniski, was watching these events very closely, and he was in touch, in communication with Volcker. And on that St. Patrick's Day of, I believe it was 82, he saw that the price of gold was dropping precipitously, and he notified Volcker that if the price of gold fell below $300, we could have a bank collapse. And Volcker's response to him, he told me, this was Jude Winniski telling me many years later, said that Volcker responded to him that no, we don't think that's a problem. We're using Milton's approach. That would be Milton's Freeman, and he's he's confident, and he thinks that if we were to add any money, it would light inflation again. And so we're not going to do that. Well, so they didn't, and the price fell below $300 an ounce. And just about that time, the banks of Mexico that had borrowed, or the government of Mexico had borrowed heavily to develop its oil industry, borrowed from the New York Wall Street banks. And Mexico announced that it would be unable to make its interest payments on those loans and would default under the present circumstance, particularly with the price of oil also falling. Not just gold, but oil was also deflating in price, as is normally the case. And so immediately upon the threat to the New York banks or the international banks of that default by Mexico on major loans, the Fed turned on a dime and decided to add more money. And added enough money for Mexico to have the funds to make its payments and so forth. And so that's the way the Fed operates in terms of what's going on. At least we can tell that from time to time on the superficial look at it that we get. Obviously, I don't get the look that insiders get. But now let's go to what their role was in the tech crash. Because this time, unlike my view of the fact that they were sort of kept on the sideline being the major player in the Great Depression, in the tech crash, they played a very central role. And it would have been known, of course, only to the insiders, which, of course, their boards, particularly the New York board, always includes some executive people from the banks and the financial firms and so forth. And so the word gets out. But what happened is the chairman of the Fed, after Volcker, was Greenspan, Alan Greenspan. And, of course, had been there. He came in 87. And, of course, within the week of his taking over as chairman, we had that flash crash in 87, which had resulted supposedly from his loose comment to Fortune magazine that he really wasn't concerned about the strength of the dollar, or whether it was strong or weak. It was okay if it got weaker with him. And we had that ripple in that sharp 1,000-point drop the following Monday morning. But he learned his lesson in a few days on that, and so he developed a policy of making sure the dollar was stable, and lo and behold, we had a pretty stable dollar between 1987 and 1996. Essentially, he kept the dollar in the range of we'll say $350, $425 gold. And the gold price at that time was much more a market price of gold than it is presently. It was not at that time subject to the kind of crass manipulation by the paper gold market, the derivatives markets that actually are now used to so-called set the price of gold, the market price of gold in the New York markets. And so we had the history of about $400 gold as being the norm by the time we got to 96. Well, the price of gold began falling in 96. And by 97, it was the pattern was clear enough to Jude Winniski that this time he went to Alan Greenspan. Now, he didn't go to him. He communicated with him, as he did pretty regularly. They knew each other. And he communicated with Greenspan that he was becoming worried that if the price of gold declines any further, there was going to be a crash in the price of oil, and we would have a deflationary environment. Well, somewhat to his dismay, of course, and to his surprise and maybe shock, Greenspan all of a sudden wouldn't communicate with him, cut off communications, and didn't respond at all. And so he sat back and swallowed it for a while, and then he became even more concerned as the price of gold continued to fall. And so he contacted the Clinton White House and raised the comment there. Well, the White House referred him to the Treasury Department. And I think at that time, Larry Summers was still the undersecretary, again, for monetary policy. And so he was invited to meet with Larry Summers. Well, he told him his concerns, and Summers basically said, we don't do gold, and we're not bothered with it at all, and more or less he got shown the door. Well, the price of oil, you might not recall, not many people do, since the more recent time we've had, practically $150 a barrel oil at times. Well, in '98, it was something like $10 or $11 a barrel. That's how much it crashed. And of course, that was disastrous for oil companies and for producers and so forth, and caused crashes in banks. We had difficulties of that kind. And but we come around to the circumstance that deflation was causing. And what it was causing, not just oil crashed, or gradually kept on going down. It wasn't a giant drop all of a sudden. It begins going down because it is a commodity, much like many other industrial commodities, concrete or steel or anything that's priced on a daily basis, sand and gravel for construction, and that sort of thing. Those kinds of industrial products are priced on a daily basis on a spot market, and therefore, when the dollar starts getting more valuable, their prices have to go down in order to sell them. Because as the dollar gets more valuable, people are willing to pay or able to pay only smaller prices, and you have to lower your price, or else you can't sell and you go out of business. So what was happening in all of those industrial companies is their profits were knocked down. They started having losses, and of course that means on the financial markets that people start selling your stock. Your stock price goes down. Those companies go into a slump. Well, in that circumstance, that was happening during that same deflationary stint between 96 and 2000. And as that deflation proceeded, the only industry, it seemed, that was still high-flying and was still profitable because it had so many customers for its new technology that it was just going to be gangbusters, modernizing the operations of banks and everything else, was high-tech. Communications and computers and technology of that kind. High-tech was flying high, as we all know. And finally, come March of 2000, the market suddenly realized, supposedly, that high-tech doesn't have customers when everybody else is on their back, with their stock prices down and so forth and so on. And when people can't buy your high-tech, you're not going to be profitable either. Well, so we have the sharp break in high-tech prices on the stock market, in the first week of March of 2000. Now, I bring all of that in focus because that is essentially what I'm going to show you was the manner in which the high-tech crash, the boom in high-tech was manufactured. It was foreseeable. I'm quite sure it was known as a product of this deflation that the Fed was purposely causing, but not announcing. Then here's the other factor that kicks in. We start having the tremendous amounts of selling in high tech in the first week of March of 2000. And we didn't learn a confirming event until the spring of 2007. And here's what that confirming event was. In March of 2007, the SEC, the Securities and Exchange Commission, announced that it was settling a major case. Now, it didn't make it sound like a major case. It was just sort of a housekeeping duty that it was doing. But let me tell you, in my estimation, it may well have been the largest case in history. Although there are plenty of other contenders for large cases that somehow went away. But this particular case settled, announcement of settlement made in March of 2007 was that Goldman Sachs had engaged in insufficient supervision of its trading platforms for a period of time. It had allowed its trading customers direct access to its trading platforms and allowed them to mark their own trades in their transactions. And in those transactions, for example, they found a clear pattern that those customers immediately began reporting short sales as long sales. Now that, of course, has a very, very significant effect in trading. A short sale at that time required, number one, that you borrow stock and furnish it at the time that stock you owned would otherwise be required. That's within 3 days of the purchase, that you've got to borrow the stock. And also, you can't make the trade until you comply, unless you comply with the so-called uptick rule. That means that you cannot sell short until the previous trade in the same stock was on an uptick, that is a buy order. And so if you mark a short sale as a long sale, you don't have to bother with that. And you can sell and sell and sell and sell and make it go straight to the floor. And of course, the SEC in March of 2007, its announcement of that settlement, it fined Goldman Sachs for this irresponsibility, its lax supervision, $7 million, I believe that was the fine. And they basically promised they wouldn't do that anymore. They were very opaque, the SEC was, in describing exactly what period it was that this affected. But they described it in general terms, and I calculated when that term would begin and when it would end. Guess when it started? It started in early March of 2007. I'm sorry, of 2000. And when did it end? It ended in early October of 2002. Precisely the beginning and the end, so-called, of the tech crash. I did not see settlements with any other major firms, but when one is doing a practice of that nature, I wouldn't be surprised if others were as well. But not only did they let Goldman Sachs off with a measly little $7 million fine that they could have paid for in a half a day easily of trading during that time, but they, about 3 months after announcing this settlement with Goldman Sachs, they also, the SEC repealed the uptick rule so that these trading firms would never again be subjected to that kind of inconvenience when they want to crash the market. Especially it would be inconvenient for all of these algorithm tradings that are able to crash so well because they do it at the breakneck speed of computer timing.
Right.
So you look at that situation, and it seems to me that in a nutshell defines exactly how the tech crash happened and why it was so severe. Many companies were killed by that same kind of watering the stock kind of trading. When you sell fake shares, no company's share price can stand up to it. You can sell them right through the floor. They're never able to mount any kind of a defense to it. They don't usually even have enough knowledge to do it. And that is essentially the answer of how the tech crash was orchestrated. It is worth mentioning also that prior to the March 2007 announcement of the settlement, about almost 12 months before it, guess who was nominated to become Secretary of the Treasury and the economic czar of the Bush administration? That would be the CEO of Goldman Sachs at the time this tech crash was done, Henry Paulson. He came as basically a billionaire, 6'5", broad-shouldered, loud, aggressive, pretty profane, and very unlikely that anybody would stand up to him in Washington. And if they did, they didn't stand up long. He came in, he was nominated in, I think, May of 2006, again, about 9 months before this settlement. And of course, obviously, that case was under investigation at the time. Not a thing mentioned about that record or that case pending when he was nominated, of course. And in that circumstance, it's my view that essentially he came down to be economic czar in order to get ready to quarterback the 2008 thing, which was, again, quite an orchestration in itself. And the events basically were in place to start that in 2007. It didn't really break until 2008, but many aspects of it did. And I can go into the 2008 thing now if you're ready to do that.